Hi guys, it's Bogdan here from System Traders. One of our viewers has asked us to show a strategy that actually works. We know we have been trashing strategies left, right and center, so it's time to show there's light at the end of the tunnel. Besides the actual strategy, we will show you some of the steps that we take in developing a strategy. Our process is complex and requires a lot of research. Running one simple backtest will not tell us anything about the strategy, and it is foolish to trade it. So here are the steps of our development. The first one is we think of the inefficiency that we're trying to exploit, and today we'll try to exploit one of the most popular ones, which is trend following. The second step is implementing a simple logic where going long is the opposite of going short. The third one is optimizing the relevant parameters after we run some tests on various timeframes and see if there's consistency in our results. The fourth one is running a walk-forward analysis and see if our logic passes the test. The fifth one is adding stop losses. Only at this point we add them. We won't be doing it for this video. The sixth one is adding money management. Betting 1-2% of your equity is pure foolishness. As you will see, we don't know what the risk is in terms of stop loss. We only know what the margin is required. So this won't be covered in this video either. And the last one is diversifying across multiple asset classes, looking for instruments that have low correlation between them if possible. Again, something not for this video. So the strategy that we're going to test is one of my favorite indicators, which is the Z-score series. Z-score is basically a measurement of standard deviations from the mean. So for instance, if a Z-score is 0, it indicates that the data point score is identical to the mean score. A Z-score of 1 would indicate a value that is one standard deviation from the mean. Z-scores may be positive or negative, with a positive value indicating the score is above the mean, and a negative score indicated is below the mean. The logic is very simple. So when the Z-score series crosses over 0, we go long one contract, and when it passes below the 0 line, we short one contract. Since we will be testing this on Nasdaq, we want to go long only, obviously introducing a bias, and we exit the long trade when the reverse happens. We will be testing this on a 60-minute chart with a lookback period for the series of 100 hours. We chose this as an arbitrary value, but one could argue it's almost 1 week of trading the Nasdaq futures. So let's look at the results since 2009, which is unoptimized. So we've had 1,569 trades, which is roughly 2 a week. The win rate is 18.5% with a time in market of 61%. We've got the 23 loss streak, consecutive losses basically, with a maximum drawdown of 24.8%. The total downtime is 91%. Annual return in this case is 29%, with an annualized standard deviation of 56.24%. So to draw some quick conclusions here, the win rate is typical of an early loss taker. It has many losses and few winning trades. But because it is profitable, it looks like it's got a positive skewness. It's got a 90% downtime, which is in line with any trend following strategy. That being said, you need a strong stomach to digest 23 losing trades in a row. That's why trend following doesn't work for most people. Even though everyone keeps mumbling how the trend is your friend, losing so many consecutive trades will be disheartening. Now, let's optimize the Z-score series look-back period between 50 and 200 hours, which is approximately between 2 days and 2 weeks. As we can see, our stable area is around 100 hours, but the algo chose 98 hours. We need to emphasize here that we now have an overfitted algo trained on in-sample data. Looking at the results, the number of trades is identical at 1,569. Percent winning is 18.6%, time in market being identical. Maximum loss streak in this case is 25. Maximum drawdown is 21.7% with a total downtime of 90%. Annual return has increased slightly to 32% with a standard deviation of 57.92. Sharp ratio, by the way, is 0.55. Now trying to draw some quick conclusions here. As you can see, a small change of the lookback period has altered the annual return, but the Sharpe ratio of 0.5 is something realistic of any strategy over the long run. As a side note, when you read the prospects of funds that show you Sharpe ratios in excess of 1, check the historical period. It's most likely the past 3 years or less, and that is dishonest marketing and at best, or even misleading on purpose. In the final step of our video, which is not the final one for the development of the strategy, so please don't run this as it is, we will run a rolling walk-forward analysis using 10 cycles. You can Google rolling versus anchored WFA. Let's see what happened here. So we've got 1,123 trades, which is 3 a week. We've got 20.4 win rate. Time in market is at 60% with a maximum loss streak of 25. Maximum drawdown is 23.3%. Total downtime is 86%, and the annual return is 41%. Annualized standard deviation is at 67.84% with a Sharpe ratio of 0.61. So let's analyze what happened here. The lookback period has decreased to 80 hours. Since the WFA was run for fewer years, the main KPIs also increased slightly because of the uptrend in Nasdaq. But so has the standard deviation at 67.84%, which in effect means there's a higher risk. As you can see, the strategy is not making money every year, but the fact that it has passed WFA is a sign that it could potentially exploit the trend in efficiency. The other steps in the strategy development are not being done, so please don't trade this. We hope you enjoyed today's strategy. If you like the video, please give it a thumbs up and don't forget to subscribe. We are happy to run a backtest for an indicator of your choice for free if you just leave us a comment with the name of the indicator, instrument, and the lookback period. Until the next one, bye.